If I told you that selling your house to a cash buying company could potentially cost you $40, $50, even $60,000 in equity just to close a few weeks faster, would you call that convenient? Because that's what we're going to talk about today. And I'm going to put my money where my mouth is. Let's just say we have a house with a $300,000 supported market value, not a random internet estimate, an algorithm, not an algorithm that's never walked through the front door. I'm talking about a value we've supported through comparable sales, market data, and an appraisal. Now, let's sell this house two different ways. One, to a cash buying business. The other, through MLS. And we're not going to compare commissions. We're not going to compare slogans. We're not going to compare who promised to close faster. We're going to compare the one number that matters when this transaction is over. How much money ends up in the seller's pocket? That's our baseline. Supported market value, $300,000. A common investor acquisition model might start somewhere around 70% of that number. Not every investor, it's an illustrative point, but 70% of $300,000 is $210,000. Right out the gate, there's a $90,000 difference between our supported market value and the investor's starting offer. So why is this? Because the investor isn't buying your house as a charity. They're running a business, and there's absolutely nothing wrong with running a profitable, but sellers need to understand whose profit we're talking about. A cash buyer can be extremely good at figuring out what they can afford to pay for your house. That doesn't mean they figured out what your house is worth. Those are two completely different numbers. Here's where I want sellers to pay very close attention. You got your $210K offer. That sounds easy. Cash. Beautiful. Quick closing. Wonderful. Maybe you're told you don't even have to make repairs. Perfect. Except, has the inspection already happened? Has a due diligence period been completed? Have you verified proof of funds? Are there funding conditions? Is hard money involved? Can the buyer still cancel under this contract? Because until you understand those things, don't confuse a number printed on a contract with certainty about what you're actually going to receive. Let's say they inspect the property, and now your $210,000 becomes $190,000. That's another $20,000 gone. If your cash buyer hasn't inspected the house, that number may not be your final number. Don't spend money in your head before you know what you're actually willing to put in your bank account, or what they're actually willing to put in your bank account. But they said I don't have to make repairs. This one drives me crazy because there's a huge difference between you don't have to make repairs and you're not paying for repairs. Let's say the inspection identifies a $5,000 problem. The investor may not reduce their number by $5,000. It could be $10,000. It could be $15,000. Potentially $20,000 or more, depending on the issue and the risk model. Why? Because they're not just thinking about the contractor's invoice. They're thinking about uncertainty, management, time, holding costs, risk, contingencies, and their required profit. You may never write a $5,000 check to a contractor, but if your purchase price drops $15,000 because of that repair, you paid for it. You paid for it with your equity. No repairs doesn't mean repairs are free. If your house needs a $5,000 repair and the investor takes $15,000 off the price, congratulations, you just paid for the item 3 times and you didn't write the check. Commitment trap. And now something psychological starts happening. You've already signed. You mentally sold the house. Maybe you're starting to plan the move. Maybe you figured out what you're doing with the money. Maybe you told your family it's done. In your head, that $210,000 becomes yours. Then the investor comes back at $190,000. Now walking away feels like you're losing $190,000. You're not. That's the commitment trap. You've just become emotionally committed to completing a transaction that still needs to be financially. The question isn't, do I want to buy the house? Do I want to lose this buyer? The question is still, is $190,000 the best financial decision I can make with this property? The most powerful moment for a cash buyer may come after you've mentally sold the house. Because once you plan your life around that closing, saying no to a $20,000 price reduction gets a whole lot harder. That is the commitment trap. We're now at $190,000. Let's estimate another $2,000 or another 2% for title, taxes, transaction-related seller expenses in this example. That's approximately $3,800. Potential seller net $186,200. Put a box around that number because I don't care that they originally offered $210,000 anymore. The seller doesn't deposit the headline offer. The seller deposits net proceeds. So stop asking, what's your commission? Start asking, how much money ends up in my bank account? Because the cheapest fee doesn't automatically produce the highest net. Now, let's sell the same house on MLS. Same house, same condition, same supported $300,000 market value. But instead of giving one business the opportunity to determine what it can afford to pay, we expose the property to the marketplace, to the general public. Let's say we don't even get $300,000. Let's say we get a $290,000 offer. And let's make this realistic. The buyer wants $10K in concessions. Fine. Let's account for the real estate fees in this example, $14,500. Let's give them $10,000 in repairs. And let's estimate another $5,800. That's 2% titles, tax, and transaction cost assumption. Where does that now leave us? Approximately $249,700. Cash investor, $86,200. MLS, $249,700. The difference, $63,500. Now we finally have a conversation worth having. No commission. Great. In this example, you saved the commission and potentially netted $63,500 less by using the cash buyer. So tell me again, where exactly did we save? Now, I'll give cash buyers their advantages because I don't want to manipulate the numbers in the other direction either. Maybe the cash transaction saves you a month. Maybe you save approximately $4,000 between mortgage payments, utilities, and holding costs. Maybe there are additional closing cost advantages. Let's be generous. Let's give the convenience side approximately $10,000 worth of advantages in our hypothetical comparison. We're still talking about tens of thousands of dollars in potential difference. That's why I say faster isn't enough information. I want to know how much is faster costing me. If you're sacrificing $30,000 to pay, if you're sacrificing $30,000 to save approximately 30 days, it's roughly $1,300 per day. Maybe that's worth it for you, but you shouldn't. But shouldn't you know that's the decision you're making? Convenience isn't free. If you're giving up $30,000 to close 30 days faster, you're effectively paying out $1,300 a day for speed. If that's worth it, take it. Just know what you're buying. So where did all the money go? This is the part that sellers don't understand. Let's take a look at the transaction from an investor side. So the non-MLS sale. Potential resale value, $300,000. They acquired it at $190,000. That's a $110,000 spread, but that's not $110,000 in profit. Let's give them $40,000 in rehabilitation. Now we're at $70,000. Give them $15,000 in holding costs. Now we're at $55,000. Another $15,000 in agents and resale expenses. We're around $40,000 in remaining before potential expenses and taxes. And businesses don't generally take substantial financial risk because they hope to break even. They need profit. Let's say they need at least $25,000. Now you can see why they couldn't pay you $290,000 for the house. The business model doesn't work. Here's what cash buyers don't put on the billboard: rehab, holding costs, resale costs, risks, and profit. That money has to come from somewhere. And part of that spread starts with what they pay you for the house. Equity harvesting. Here's a concept worth understanding here. An investor creates an opportunity by acquiring a property below its anticipated market or resale value. That spread helps create room for repairs, expenses, risk, and ultimately profit. Again, that's business. I'm not telling you they're evil. I'm telling you to understand the transaction, because a person buying your house is negotiating for their financial interest. They're not your representative. They're not sitting on your side of the negotiation table. I don't hate cash buyers. I'm against sellers making six-figure financial decisions without understanding who is sitting across the table. They're representing their money. Your agent is supposed to be representing yours. Market value is not investor value. This is another huge distinction. A professional market valuation is trying to answer What's the property reasonably worth in my marketplace? We're looking at comparable properties, condition, location, features, current competition, or recent sales, market behavior, and in my process, I want an appraisal helping establish the baseline. An investor is answering a different question. What can I pay for this property and still make the deal work? That's not an insult. That's literally their job. But don't confuse their acquisition price with your market value. Your cash investor isn't necessarily telling you what your house is worth. They're telling you what your house is worth to their business model. Those are not the same things. Market exposure. This brings me to another phrase people love, off-market. Sometimes privacy does matter. There are absolutely sellers who don't want their property publicly marketed. That's their prerogative. I'll work the transaction the way the seller wants it worked. But understand what you're trading. Private means less exposure. Less exposure means fewer opportunities for buyers to compete. And fewer opportunities can mean less price discovery. An investor wants to find a deal before the broader market gets a chance to price it. That's the investor opportunity. Off-market sounds exclusive, but nobody else gets a chance to make you an offer. But if nobody else gets a chance to make you an offer, how exactly did we determine that one offer you received was the best one? Exposure creates opportunity. You can sell as is on MLS, and we've got to kill that misconception. As is does not mean investor. You could sell it as is on MLS. You could sell a dated house on MLS. You could sell a house that needs work on MLS. Also, old flooring, old kitchen, and ugly paint isn't automatically distressed. That's dated. Major structural issues, significant deferred maintenance, and serious mechanical problems, now we're talking something different. Condition matters, but condition doesn't automatically dictate your selling method. Grandma's 1988 kitchen isn't automatically a distressed property. Sometimes it's just ugly. Don't give away $50,000 in equity just because the cabinets need updating. Cash doesn't automatically mean no financing risk. That's another nuance sellers hear. Someone can present what appears to be a cash transaction and still have financial dependencies behind the scenes. Hard money exists, private money exists, partners exist, and buyers can exist depending on their business. I'm not telling you every transaction contains those things. I'm telling you read the contract, identify proof of funds, understand the due diligence period, understand funding requirements, understand cancellation provisions, know what you are signing. Cash is one characteristic of the offer. It's not a magic word that eliminates every transactional risk. Cash doesn't mean risk-free. If there's hard money, another end buyer, due diligence, or cancellation rights involved, there are nuances behind that word cash that you need to understand. What exactly is guaranteed? When someone says guaranteed cash offer, I immediately have freaking questions. Has the house been inspected? Has due diligence been completed? Have funds been verified? Are there funding dependencies? Can the buyer still cancel? Is this actually the final purchase price? Because if the answer to those questions is no, what the hell is the guarantee? What exactly are we guaranteeing? Guaranteed cash offer. Okay, great. Have you inspected it? Have you proven the funds? Can you still cancel? Is this the final price? If not, please tell me which part is actually guaranteed. Now there's a third option, and this is where I think sellers get trapped in false choice. They think they have two options. Wait forever to get $300,000 or take $210,000 today. No, there's a massive amount of real estate in between those two numbers. We can use MLS strategically for speed. If our supported market value is $300,000 and your priority is to getting the house sold quickly, maybe we're not trying to squeeze every last dollar out of the transaction. Maybe we just position aggressively. Maybe our marketing strategy is built around immediate exposure. Maybe we use the price to create urgency. Maybe we prioritize strong terms over absolute highest offer. If I can get your house sold quickly and still put $30,000 more in your pocket than an investor, now you got a real decision to make. Your choices aren't $300,000 someday or $210,000 today. There's a giant middle ground called price it aggressively, expose it to the market, and still beat the cash buyer's net. Days on market matter. Every market has an absorption rate. Every price range behaves a little differently. Every property has competition. That's why days on market matter. If your financial institution gives us 45 days, that's different from someone that needs the house gone immediately. And price is one of those tools we can use to influence speed. I can adjust an MLS strategy towards maximum net or towards maximum speed. That's very different from immediately surrendering the entire gap between market value and investor value. So let's put all three options on the board. Option 1, maximum net MLS. We're going after market value, maximum exposure, strong marketing, normal market timeline. The goal, put as much money as reasonably possible in your pocket. Option 2, speed-focused MLS. We're intentionally more aggressive. We use price and marketing to create urgency. We prioritize strong terms and faster execution. We may leave some money on the table, but potentially going nowhere near what we surrendered to an investor. The goal, balance speed with equity preservation. Option 3, investor cash. Potentially the fastest, potentially the simplest, potentially more private, less market exposure, and generally a significantly larger discount has to exist for the investor's business model to work. Goal, maximum convenience. There isn't automatically a wrong choice here. There is an uninformed choice, and that's what I don't want sellers making. So when would I actually tell you to take the cash offer? Absolutely, there are situations where I would tell a seller, take the cash. Foreclosure is a great example. If your foreclosure timeline is going to beat realistically the MLS absorption rate and closing timeline, we have a different problem. Protecting the equity you can still protect maybe become more important than maximizing every dollar. The condition of your property creates a serious problem. Maybe your circumstances make speed overwhelmingly important. Maybe we run all three options and an investor number is generally strong. Then take it. This isn't about protecting an MLS commission. This is about protecting my seller's objective. I don't hate cash offers. If the cash offer is actually your best financial option, I'll tell you to take it. What I won't do is confuse convenience value before we run the numbers. Inherited properties are where this becomes especially important because uncertainty is enormous. You may have an inherited house you haven't lived in 20 years. You don't know the roof. You don't know the plumbing. You don't know what the kitchen does to value. You don't know that whether the foundation is fine. You don't even know that you inherited. You don't even really know what you inherited financially. But uncertainty makes a simple cash offer incredibly attractive. Just take this problem away from me. I understand, but the uncertainty should create a need for information, not panic. Let's inspect. Let's establish value. Let's understand condition. Let's calculate potential repairs. Let's establish cash net. Then you decide. Inherited house and have no idea what you've got? Don't start with an offer. Start with information. Condition, value, expenses, net. Then we sell it. 5 things I do before accepting a cash offer. So if somebody calls you tomorrow and offers you $210,000 for your house, don't immediately say yes or no. Do these 5 things. 1, establish independently supported market value. What's this thing actually worth? 2, understand condition. Go ahead, get ahead of the inspection surprises. 3, verify the offer. Proof of funds, due diligence, funding nuances, contract terms. Understand what you're actually holding. 4, calculate the cash buyer's realistic final net. Not your headline offer that's on the top of the page, your net. Number 5, calculate a realistic MLS net and timeline. Maximum net strategy, speed focus strategy, and cash strategy. Put all 3 beside each other, then make a decision. Certainty versus certainty. This is where, and this is really what this entire conversation comes down to. Cash buying businesses sell certainty. And they're right about part of it. There's a buyer standing there. That can feel incredibly relieving. There's a certainty of a buyer. I want certainty of information. What's the condition? What's the supported market value? What's the realistic selling price? What's the timeline? What are the expenses, the risks? And most importantly, what is your potential net? Because once we know those things, we don't have to play the what if game anymore. What if nobody buys it? What if it needs repairs? What if it doesn't appraise? What if it takes forever? We're going to gather that information reasonably, look at the market, build a strategy, and make a financial decision. So if you're thinking about selling, especially if you inherited property, your house needs a little TLC, you have already received one of those cash offers, I'm not telling you to take it. I'm telling you something much simpler. Don't make a decision emotionally. Don't make it because someone promised no commissions. Don't make it because someone said no repairs. Don't make it because the word cash sounds guaranteed. And don't make it because the algorithm spit out a number and somebody put it on a contract. Find out what you have. Find out what it's worth. Understand the condition, the timeline, calculate the cash net, calculate MLS net, and if speed matters, calculate speed focus MLS net too. Then put all three numbers on the table. Maybe cash wins, maybe maximum market exposure wins. Maybe the answer is somewhere in the middle. But now we're making the decision from information instead of fear. Take the emotion out, work from certainty, and then you decide.